All right, good morning, everybody. We got a busy week, and generally on a week like this, we would do what I call hurry up and wait, where the market goes sideways or sits in a range. Those are two different things. Testing the edge and really just not going anywhere while we wait on these big events. But want to just prepare you for the idea that we could break and run. We've seen it in other FOMC weeks where we run on Monday and Tuesday. So it's not unprecedented. It can happen. Just want to put it out there. While the base case is that we would go sideways and wait, it is absolutely possible that we could just break out and run, right? So keep that on your radar. I'll be playing the base case until we get something that says to do something else. Playing the reversals until it fails on the idea that the losses, it's an LRE, it's a low risk entry. The losses are smaller. And that if the trade is wrong, we'll still make more on the run than we lost on the failed reversal attempt. We have part one of QRA today at 3 o'clock. Part two on Wednesday at 8:30. And then FOMC release at 2 o'clock on Wednesday. And then Powell statement FOMC at 2:30. Tariffs on Friday. But with the EU news that came in today, a lot of that angst for Friday's deadline has been removed, right? The one big one was the potential for EU retaliation, and now that seems to be off the table. So the UK basically flat, US, the Dow, the S&P, both less than a quarter, small caps up more than a quarter, and tech leading. There's a lot of quantitative analysis that we can do when it comes to what they call the meme stocks or the meme run, and it comes in waves. And they were discussing last week's wave and how it really didn't have the same push to it as what we have been seeing. So we still got another week of it, right? We saw that, but the week was less robust and died off sooner than the previous pushes have, right? So it's slowing down. They also keep track of the amount of money coming in, and they're saying that they don't call it stupid money on Bloomberg. They call it something else, like uninformed or uninitiated. Right? They're basically people who aren't traders but can download Robinhood or Webull, and of course all the Coinbase and places like that. The inflows of capital have been staggering this year, and it is higher than when we had the real meme stock frenzy, I guess is a good word for it, back in the day. That's a lot of capital. The difference is a lot of those funds and firms now have rules in place, and they have all those word generators, word calculators that detect when collectively people on Reddit or other social boards are all chatting about a particular stock. And I mean, even Thinkorswim's got one of those tools now, right? So it's a common thing to monitor retail traders, which is funny if you'd have said that to someone 10 years ago, that retail can move markets and that we need to monitor what retail is doing, they would have fired you and you'd have been laughed out of Wall Street. Not anymore. I know a lot of traders who take the week off when it's FOMC, and especially when it's QRA FOMC. It's likely to be a difficult week. And yet I say that, but I had one of the biggest mornings that I've had in, it's been a while, but this really nice drop that we had. I'm already done with next month's. I was done with next month's the last week, but I would say this just put me through to October. So it's supposed to be a rough week. So far, it's been a really nice start. See where we go from here. Good thing is if we keep getting price action that looks like that, we could just finish the year up by the end of the week. Go do something else. A lot of auctions today. They're all in the front end though. So you could use, like IRX or something, just collectively watch all of them. Some jobs data tomorrow with Jolts. It's not the jobs data, right? But it's still, it's jobs data. Anything jobs related, want to keep your eye on it. They were talking about the S&P at 23 multiple and how that's sort of the ceiling and the topping off point. We really struggle to get higher than that. We're not looking for an excuse yet, but we will be getting there soon enough. I got a lot of work done on the moving average rate of change. Should have that released by Wednesday or Thursday. And of course, I'll end up putting it in the Thinkorswim workbook, which is that Discord channel where I share all of the Thinkorswim links. The put wall was rolled down and the call wall was rolled up, but only to their previous levels. So the last low that we had on the put wall is back where we are now. And the last high that we had on the call wall is where we are now. 65.35 and 58.35. 700 points between those two. It doesn't feel like low volatility when we have a 700 point wide box. They only make the box really wide when they anticipate big moves, which is another way of saying it, implied volatility. We're looking at 60,000 for the overnight. All things considered, that's a good start to the week. We're not coming in light. But on the other side of that, it kind of goes against the argument that this is supposed to be, a boring, quiet start to the week, and that we're going to hurry up and wait. With a hurry up and wait, we would have expected a lower level of volume. Watch for VWAP reciprocation, by the way, if we can get back above that. $64.26 is the lower ADR. If we can get there early enough, we can go to the other side by the end of the day. I say that, but the day is already half done. So, if we're gonna do it, we better get down there and get it done. It is worth noting that we would have to break back inside Friday's range to be able to tag it. And also the idea of where these are located. Now, this is a little bit of a function dysfunction. You like that? Some platforms draw these ADRs different ways. On Thinkorswim, it calculates the ADRs based on where we opened at 6 o'clock last night. So that green line is the midpoint between these two red lines. I think on TradingView, it uses where we closed on Friday, and it will draw the two lines based on that location. And if we had done that, we already hit the upper edge of the ADR. Now we're fading back down to close the gap from where we, closed on Friday. Now the gap close has no bearing on these lines at all. We're still working to close that gap either way. And so far, we haven't even gotten back inside of yesterday's range. When we open at 9:30, Thinkorswim and TradingView, all of them, when it comes to the SPX, these lines are going to develop at 9:30, wherever we happen to open. So if we open, gapped up in the SPX, the lines will be set there. And if we don't, then wherever we're at, that's where we're going to get these lines. When we get this sort of behavior and it screws the levels up, keep your eye on the SPX and the SPY and its levels, sort of a backup, because this is a discrepancy that it can be misleading, right? So if you're trading futures, just keep your eye on SPY and SPX and its ADR levels. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it. That's also bullish. And so far, we haven't hit the daily pivot, but it won't count as an MDP, missed daily pivot, until tomorrow. Right now, it's just a pivot that we haven't hit yet. Say yet, because markets have a habit of hitting their pivots more than not hitting their pivots. The channel's wider than it was on Friday. Wide channels imply that if we break out, that the breakout doesn't stick and we don't keep going. And so far, we have already broke out and we're trying to come back in again. Just keep in mind, these channels don't make price. Do anything, they're nothing more than a math formula based on previous days, high, low, close, and some math behind it, right? It's just a math function. You can always just Google central pivot ranges and get the math formula if you want to check it out. It's all public. It's been around, 20 plus years. There's no secret to it. So right now the idea is get the gap closed, get back to Friday's close, get inside the channel, get to the pivot. We do have to worry about how far we are from the weekly pivot and the weekly channel. If we get too far away from that thing, we'll begin to mean revert. Unfortunately, there isn't a really good way to define how far is too far, but 1% is not enough. I've seen us get, 3.5 to 4% away from the weekly pivot. And then that is around the area where it's a bit too much and we start to pull back the other way. But 1%, that's not enough. We got 64.32 cog line for yesterday's high and 63.92 cog line as the weekly floor pivot. Should love all those cog lines just lining up nice and neat for us. Just be mindful that coming in this week so far, we still don't have any bearish signals yet. Now, a lot of people don't play confirmation style trading. They trade before they have the signals. And I get that, right? Why wait until, we've already been moving in a particular direction for a while and your risk becomes elevated. You have to pay for confirmation. But this grind higher has lasted longer and we have gone farther than anybody has anticipated. And the old phrase, markets can stay irrational longer than you can stay solvent, that phrase exists for a reason. So yeah, I get it. We're at extremes. You want to short the market just because, but so far that trade hasn't worked. So if you can do it by keeping your risk down low, why not, right? Just don't put a lot of money on it. Don't put a lot of risk into it. We've already hit R2. Now that we've started working our way back, S1 would be the default at 64.11 cog line. But I think what comes into focus more than S1 would be the midpoint of yesterday's trading range, right? We get through yesterday's high, we get through the close, the daily floor pivot, and then the midpoint of yesterday. And I think that would have more weight than the S1. Also, the true close line is really close to that S1 as well. So all things considered, I would say the true close is likely a better play. I say that, but with that flip right there by 10, true close is lower than that. It's closer to 6,400. So yeah, play S1, then true close, then yesterday's low, level by level. Solid distribution at 6,400. There's really no surprise to that at all. Gets really shallow below that, and then we see it develop again around this 6370 area. So sort of a classic double distribution. I wouldn't look for a triple distribution, right? Like if these two nodes are too close together, just kind of wrap them into one. But the shallow area between them does sort of highlight the fact that we've got, a pretty decent double distribution. Ten-day, 30-minute volume profile in TPO. Again, we can see that large volume node or volume shelf between 6400 and 6411. It's a solid structure. The question at this point is, one, are we even going to get down there to interact with it? And two, if we do, is it going to be strong enough to hold us up? I don't like gaps up like this, right, at the highs. Now, you get a reversal off the lows and then a good solid gap up. Hey, I'm a big fan. But these gaps at the highs, when you look back in history and go find them, a lot of times they are the reversal points for the next leg lower. Okay. As we talked about last week, we're going to take out more of this volume that's in the value area down here, and we're likely to see the point of control move up to this box that I just drew, both on the TPO and the volume profile. The TPO is really not reflective of the same level the way that the volume profile is at this point, but we'll see if that widens back out if we can get back in that box. By default, that's where the volume profile point of control is going to end up when we wipe these candles out down below here. Should take another day and a half at least, but it's possible that by tomorrow morning, depending on, if we come down in here today, we could see the point of control up there. We have another VPOC that we earned on Friday. I just set mine to a round number, but if you want to, you can dial it in and put it right on the line. I don't get too excited about it, right? I'm not going to nerd out on it. 64.28 seems to be as close as I'm going to get. So if we do break down back inside of Friday's range, 64.28 got a lot of volume there from yesterday, right? The idea behind this is doesn't act as a support and resistance per se. Try not to think of it that way. That has bias in it, right? Try to keep your bias out of it and just focus on, well, what does it represent? It's the greatest amount of trading activity that happened on Friday. That has no bias to it. That's just a statement of fact. If that's where the greatest amount of trading volume took place, then we can expect that there is going to be some trader's remorse. Maybe people who went long are looking at their trades from Friday and thinking, well, price is back to where it was when I got in. Maybe I want to double down, and somebody else is going to say, well, maybe I just want to take the trade off. Shorts get to reevaluate, longs get to reevaluate. We could see people respond at that level simply from trader's remorse. If it's where the greatest amount of trading volume took place the last time we were there, we expect more trading volume when we get there again. So on Friday, we were looking at next week's range and comparing it with the range that we had, and they were not far off, right? They were pretty close together. It was a little bit of a discussion because we would anticipate that this week, having so many things in it, would have a narrower week for the expected move. This is where we get the basis on the week of what are we expecting? A lot of breakout and runs, or sitting sideways waiting on some big economic event. And that's helped so much over the years, just having a good starting point for what are we expecting this week. But we don't have a good tell this week. It's not really narrow, telling us that, we should be expecting the market to sit on its hands, and it's not really big, suggesting that the market is pricing in a bunch of volatility. It's a little narrower than what we had last week. That's it. Just a little narrower than last week. So a narrower range does imply the market is expecting to see a sideways market. But I don't like kind of sortas and, gray areas, just like really defined, clear examples. And this isn't clear enough. Sure, it's a little narrower, but that's it. So while the base case is that we go sideways into FOMC on Wednesday, this says proceed with caution, right? Don't get too heavily invested in that bias. It's not narrow enough. If it had been narrower, I'd be more strongly convicted. We're still 3.6% above the 10-week. Hopefully, sometime this week, I'm going to get the rate of change indicator. And once we get that done, we'll have a better idea of how much the 10 is moving towards us each day and how much we have to continue to move to the upside just to keep our distance, right? Which is kind of one of the purposes of getting that rate of change coded. Simply put, if the 10-year is moving and price is moving, and we're wondering when the 10 is going to catch price, this is the old math formula from school, right? If you're in a car doing 65 and the train is doing 135, what time are you going to get to the station kind of question. We're still maintaining our distance from the 10-week, but we've continued to, get new highs, new highs, new highs, new highs. Even though most of those new highs haven't been kept on a day-to-day basis, right? We would like spike up into them and dump back down. We're still maintaining that distance from the 10, and we're going to begin to lose that if we can't maintain that daily travel. And as long as we don't get big blowout days, we won't outrun the 10 and get extreme again, like we did back here, 5, 5.25. We're still above 1.5 to 2, so we're good, and we're less than 4, so we're not extreme, and we're just cruising along. Everything is safe, fine. There's no threat or risk. We are 1% above the 10-day, and this is on the decline after getting into 1.25. Again, it's fine. This is a good, safe place to be. We're not overbought. We're not overextended. We haven't moved too far, too fast, and it doesn't owe us any sort of mean reversion. No least squared methods or dot plot statistics or anything else that suggests that we need to flip back and go the other way. So we're on pause with any sort of signal that says this move has been too much. Because it hasn't. Mag 7 down volume is down. I know it's a little weird with a double negative. Gold miners, uranium, bonds are down, but not enough. We need these down a little bit more. Our benchmark is 0.5%, so we're just not there yet. Looking at what's up this morning, Bitcoin, which I did mention last week, right? Because of the AI conference in China, that big blowout event that I haven't heard jack on. If you don't go hunting for that, apparently you just won't find headlines on it. But that's been running all weekend, and Bitcoin liked it, as the expectation was, right? I'm not a huge player in the Bitcoin space, but from time to time, get a little something. And when you're sitting around in waiting rooms doing nothing, you might as well play Bitcoin over the weekend. Might look for a follow through to this today if you're trading stocks, or if you just want to stay away from the futures space during this wild week. MSTR, Riot, Mara, Hut, Hive, all those Bitcoin stock plays. We can see the Mag 7 up volume is up. Chips, energy, and then of course we got the mags there. Consumer discretionary. We've got the Mag 7 collective, but it's not up enough, right? We need it at 0.5%, and it's just not there yet, but it's moving in the right direction. So all of these are a good indication that we could keep this breakout, but I'd want to see more, right? Chips is good, Mag 7 is good, and Bitcoin. But let's see it spread out a little bit more, right? I'd rather have finance than energy, all things being equal. So, let's get a little more out of finance, and banks are all the way down here. We need more. But this is a really good start. If we want to keep this breakout, that's exactly what we would want to see. Crude is leading to the upside the most. I think I'd rather have that than, some pot stocks or solar, nat gas leading the way. Behind that, Bitcoin, then chips, and then there's a pot stocks. They're always in there somewhere. And the Mag 7 is up. It's a good start, guys, but we need to see the options flow today, which we're not going to see until we get into the day. And we need to see if this is going to be one of those rising tide events, right? Where you get all the good stuff running, and so everything else just sort of populates and comes with it. All things considered, we got a relatively easy day, especially judging by what we had this morning, right? I mean, that was fantastic. Looking at the market over a 5-day period, this is that rising tide scenario, right? Look at what we've been dealing with over a 5-day period. Finance up 2%. Industrials more than 2. Energy more than 2. Healthcare more than 4, but we'll just stick with more than 2. So all of those, that's 4 out of 9, not quite 50%. Then building materials is close, not quite there, but close. And the rest of these, I mean, the only one that seems to be squishy is XLK. It's up at 0.25%. So, it's the one closest to going to 0 and then turning negative. The utilities not far behind that, and staples with it, right? Consumer discretionary. Those two, by the way, shouldn't be so close together. XLY and XLP are on opposite ends of the spectrum, right? It's like comparing a little Ford hatchback to a Porsche. Opposite ends of the spectrum. So those two should not have the same rate of change on the week, or a 5-day change on the week. rising tide. So, okay, it's going to be pretty simple, guys. We got to get out of the box. If we can get out of the box to the downside, that's going to put us inside of Friday's range. Focus on Friday's high first, and then Friday's close, and then the midpoint of Friday. And I missed my tag up here, but it's close. 64, probably 64.20-ish or something like that. 64.15 is the midpoint of Friday. So level by level, just run it. And if we do flip and start heading back up, we want reciprocation on the VWAP. So however far we got below the VWAP, that's what we expect above the VWAP. And if we measure it, I bet it comes back up to that high right there, but whatever, we'll check. So it's a really simple morning. So far, it's been really nice price action. Just get out of the box. Yeah, not perfect, but close. Gets us close to that high. That would be reciprocation. Otherwise, if we don't get out of this box will become our trading range. And then it's going to be choppy, sideways. And the difference between sideways and range will be how we respond to the edges of the box. Right? That's what I got for you guys. Be careful, be safe. Watch the clock today, 3 o'clock, right? 3 o'clock QRA. I'll see y'all tomorrow.